Okay, it's now time to talk about asset location, asset allocation, and retirement plan withdrawal strategies. First, I'd like to tackle the retirement plan asset allocation question. When we talk about asset allocation, we're basically talking about portfolio construction, how certain assets are held in portfolios, the percentages. Just think of that that pie chart that you've seen probably too many times already, where we have assets broken down by maybe large company stocks, small company stocks, bonds, international stocks, other types of securities. That would be a portfolio or an asset allocation across the portfolio in different percentages. And so when it comes to planning for accumulating assets for retirement and withdrawing those assets, we're going to first need to look at the amount of exposure that we want to have in that portfolio based largely upon the client's risk return or their risk profile, their risk tolerance. And once we arrive at the risk return dimensions that we want or characteristics of the portfolio, we're going to need to take the steps of determining where these assets should be held. Should these assets be held in a taxable account, a tax-deferred account, maybe even a tax-free account? And so that's where we talk about the asset location decision. But to have a better idea or a better feel for what we mean by asset allocation, let's go ahead and jump into Wright Capital and take a quick look at what they already have in terms of model portfolios. So I think the best way to do that would be simply to go to the investment tab and go to the left side. Once you click on investments, this bar opens up and you see asset allocation. And we can then go to the right-hand side and take a look at the model portfolios. We start with the preservation portfolio. This is a very conservative portfolio which has a lot of cash and fixed instruments, and that explains the 80-20 mix here. 80% would be the fixed portion of the portfolio, 20% would be the equities, the stocks, real estate, and other holdings. So when you look at the returns, as you can see here, there's an annual return of 5%. So if you were to adopt this portfolio as your own, then what we're saying here is, according to the capital market assumptions table, and we'll take a look at that also, we need to know which capital markets assumptions we're using in this particular plan. We discussed that in an earlier chapter, but we'll look at it more carefully here. When we have a conservative allocation, you have the returns that are fairly low, of course lower than your more aggressive portfolios, and of course the volatility is fairly low as well. So the standard deviation, that's the amount of swing that takes place in that portfolio over time, is relatively low compared to the estimated or expected returns of the portfolio. Let's move on up the scale though, and let's go to a moderate portfolio. With the moderate portfolio, we've now moved up to 60% equities and 40% fixed instruments. And as you can see here, we have U.S. equities, international equities, emerging markets, we have real estate. Those are all of the asset classes that kind of roll up into that equity portion of the portfolio. And as you can see, that consists of about 60%. The remainder being U.S. bonds and international bonds, the 40% of the remainder of that portfolio. But as you can also see, because we've moved up in terms of risk and expected returns, we're looking at more of an 8% return now, with almost double the standard deviation or the volatility of that portfolio. So the swings will be larger in different market conditions. Let's move on up now to an aggressive portfolio. This is probably, yes, an 80-20. We had an 80-20 portfolio, and as you can see, the equities continue to grow. International equities increasing to 21%, so that's 47 and 20, 67, almost 68% there. Another 8% in emerging markets, so a pretty nice slice is starting to go to emerging markets, highly volatile, but also high expected rates of return. So the mix of the portfolio is being heavier in equities and is being reduced in the area of fixed instruments. And here now we have an annual return of 9.5%, and I can tell right now this is probably the CMA that's being used. The capital market assumptions would be the historical rates of return. And we'll look at that again in just a moment. And the standard deviation, as you can see, is 12 or a little bit more than 12. So the swings are even more dramatic, or the portfolio can be considered to be more volatile. So as the market changes, either up or down, then this portfolio is going to move more quickly or to a greater extent than you would see with the more conservative portfolios. Okay, so let me go over to the capital market assumptions page, and let's take a look at the types of returns that we can expect from these types of securities. For example, the 13.6% that's attributed to U.S. equities. Let's look at the composition of that equity portion, the U.S. equities, and see what types of returns they have just for that particular asset class. And to get there, what we'll do is go back out to the gear, because the CMA, the capital market assumptions, that is something that you'll set up at the beginning of the case, and you set up a lot of the assumptions using the settings tab here at the gear. Okay, you have methodology, where you cover a lot of items that are basically template type things that typically these would not change across the plans, but there may be an occasion to change that. But let's look at the return assumptions. And as you recall, I talked about CMAs, capital market assumptions. There were two that I'd mentioned. One is historical, where you're looking back about 50 years at the returns of certain asset classes and carried that forward. So we're looking back to maybe 1975. They go back even further. So you can easily do that. Go back to like 1926 if you want to. But I believe Wright Capital stops at about 1975. They capture 50 years of historical returns. And so over that 50-year period of time, as you can see, historical index, pretty hefty returns here, pretty optimistic. Okay, so that's the concern with some advisors, is that when we look at what's the environment that we're in today and going forward with the economy, then will we be seeing these types of returns? And so there are options provided for us. But let's just stick with historical returns. And as you can see here, when we talk about U.S. equities, there are certain returns that are kind of embedded there depending on the type of U.S. equities that would be held by the portfolio. International equities, same thing, 2% dividend, 7% capital gains to make up a 9.6% total return for that particular asset class. And so as you work on down through the pages, you can see the different asset classes have different levels of returns, starting from the more optimistic ones, the equities, and moving on down into the fixed instruments here. So when we set up a portfolio, conservative, moderate, aggressive, very aggressive, that's what we're doing. If we have 50% in equities, we're going to have 50% of the portfolio that's going to be earning anywhere from 9 to 11% or 10 to 11% roughly, or 10 to 12%. If we have real estate, then we're going to be adding a slice of that portfolio, maybe real estate 5% of the portfolio. That 5% is going to be earning 8%. And so you take all those together, those asset classes with those differing levels of returns, and that's how you come up with an overall portfolio expected rate of return and its expected standard deviation or volatility of the portfolio. Okay, so let's jump back now. There is one thing I failed to do, and that is to show you the forward-looking capital market assumptions compared to the historical. So as we were discussing, historical rates, very optimistic. This is looking back over the last 50 years or so. But when you switch to the JP Morgan capital market assumptions used by a lot of firms today, as you can see, they're much more conservative. And so a lot of people like or prefer to use these more conservative capital market assumptions in their plans. Okay, we can now move into the PowerPoint deck where I talk about asset location. Let's go ahead and go to the second slide here. Okay, asset allocation we've discussed. That's the pie chart, which holds different types of asset classes. So asset location, we're basically talking about where you're going to now hold those assets in your three different types of accounts that we'll be looking at. One would be the taxable account. I'll also refer to that as the brokerage account. Generally, when you talk about a brokerage account, you're talking about a taxable account. And so there's the brokerage account. There's a tax-deferred account, such as an IRA or a 401k plan. And then there is the Roth account, which is basically the tax-free account. So taxable, tax-deferred, and tax-free are the main types of accounts we're talking about. Let's look at the characteristics of the taxable here. Number one, annual taxes on interest, dividends, and realized gains. So you may begin to think, okay, well, when we're talking about bonds, recall bonds have bond interest. Interest is being spun off of that. Also with real estate, the income of real estate has to be distributed under some rules for real estate trusts. And so there's certain types of investments that just have annual tax that would have to be recognized on your tax return. Okay, and so the least efficient place to put those would be in a taxable account, because every transaction where there's interest being paid or some other form of income being paid by that particular asset, that's going to end up on the tax return. So it may be best to hold those in some type of a sheltered vehicle. The advantage of the taxable accounts, however, are those long-term capital gains rates that could apply when you have gains on assets. So if you have high basis stock, let's just say you purchase stock, $1,000 worth of stock, and your basis in that entire holding is $800, then really you're only dealing with $200 worth of gains. And those gains may be, if they're held for the required period of time, 1 year, would be long-term gains and possibly taxable at 0%, 15%, low capital gains rates, compared to if you had an asset that was, if those same assets were held in a 401k plan and you took a distribution from that 401k plan, all of that comes out as ordinary income at whatever your marginal tax rate is. So there can be an advantage to having equities held in taxable accounts. What we need to look at, though, is what types of equities are we looking at? Are they low basis equities? Are they high basis equities that it would have very little gain to be taxed if you were to actually sell those, liquidate those for income? Would your tax bill be low? And then again, that turnover question, or is it a mutual fund that has a lot of activity going on during the year and constantly recognizing sales, which may be long or short-term gains, and those shorter-term gains are taxed at a higher rate. So again, another decision to be made with respect to where you want to place those assets. Equities, generally speaking, can be a good candidate for the taxable accounts. High turnover may cause you to look at that and say, well, I'm not sure. We may want to put those over in maybe a Roth account. Okay, so we beyond taxable accounts, we have tax-deferred accounts, and this is where we talk about the IRAs, 401k plans, those tax-protected accounts. As you see here, taxes are postponed until you withdraw those assets. So I can contribute to an IRA or a 401k plan for 20, 30, 40 years. But every dollar I then pull out of that IRA or 401k plan, regardless of whether it was in real estate or tax or bonds or some other type of investment, each dollar is taxed coming out of that. Okay, so again, the decision to be made, what type of securities would I like to have in my 401k plan? And so finally, you have the tax-free accounts, and I'm kind of in the way here with my image, so I'll move myself up here. Qualified withdrawals are 100% tax-free. And so again, we need to decide on which types of assets may be suitable for that. Okay, looking at those accounts, tax sheltered first, that would be our IRAs and our 401k plans, which have tax deferral. That's where you'd put your least tax efficient types of asset classes, because it's a protected account and there are no taxes as long as that is held inside that account. Now, when the money comes out, like a 401k plan, when the money comes out, it is taxed as ordinary income. But at least during the accumulation stage, if you have assets like real estate investment trusts, for example, this bullet number 2 here, bonds, taxable bonds, corporate bonds, government bonds that are paying interest, or you have high turnover funds where you have an active manager who's constantly buying and selling stocks. Well, that needs to be happening inside some type of protected wrapper, so we're not recognizing gains every time there's a sell of that stock. And so when you have that kind of activity, that type of high turnover, that may be more suitable for a tax protected account like a 401k or an IRA. For taxable accounts, this is where you'd have your exchange traded funds, index funds, where you're buying an entire market index and you're buying and you're holding. There's not a lot of trading going on. The S&P 500, there may be a company or two that'll drop off or come in the S&P 500 where there may be a minor trade, but generally you're buying the entire market and holding that. So those just continue to grow and you have embedded capital gains, but you're not having to recognize those because you're not constantly selling those types of securities. And we have, of course, municipal bonds. Those are tax-free. The bond interest is not taxable. So having that in a taxable account, a bond that is a muni bond, which may not be taxable, then you're not having to recognize that annually. So the low turnover funds, funds like S&P 500 index funds, which you're kind of taking a buy and hold strategy there, as well as those, as well as tax managed funds. This is where the job of the fund manager is to manage that fund so that if they're kind of offsetting or they're having tax loss harvesting, they call it, where they're harvesting losses to kind of offset those gains that the portfolio may be recognizing. And so the goal of that manager is to manage that very tax efficiently. So having that in a taxable account and having someone who's managing that to try to keep from having a lot of gains is another type of asset class that may be suitable, or a fund that would be considered or labeled a tax managed fund may be suitable. And then finally, we have the Roth accounts, which are very suitable for equities, especially long-term holdings, holdings that have a lot of potential high growth, emerging market stocks, small cap stocks, which may be more volatile, but they have, on a longer term horizon, they have higher rates of return on average than other types of investments. Your Roth account's the one you want to have growing for decades without being tapped into. And as long as those asset classes that have high returns are sitting in that Roth account, you can have a lot of growth. And remember, it's all coming out tax-free. So that's the real cool thing. You're having high growth assets in a tax-free account. Now, just to give you an example of the difference in a taxable account and a tax-free account, just to show you how significant the difference can be. Suppose you had an asset, and let's see what type of asset we have here. Is it a bond? Yes, we have a $250,000 taxable bond fund. Okay, so we have some other specs here. Individual age 40, holding this for 20 years, a 20-year bond with a 6% rate of return. This individual's in close to a 36% marginal tax bracket. If this bond had been held in a taxable account, you're looking at roughly $532,000 that they would recognize in 20 years. If that money had instead been held in a Roth IRA account, you're looking at, here it is, $288,000 more dollars that could have accumulated, and that would be tax-free to that individual. But unfortunately, that was held in a taxable account, and there was just a nibbling away over 20 years of taxes on all of the income that was being generated by that bond, by that taxable bond. So as you can see, this is just one example of how, depending on where the type of asset that you have, taxable bond, non-taxable bond, if it's an equity or mutual fund, is it a high turnover mutual fund generating a lot of taxes? Should that be held in a tax-deferred account or maybe even a Roth account, so that if there are gains that are being recognized by that fund, at least they're not being taxed because they're sheltered by those tax wrappers. Okay, and finally, we can wrap up with this summary of what we just discussed. Number one is understanding the distinction between asset location and asset allocation. Asset allocation is basically the construction of your portfolio and how your assets are the proportionate shares of assets across that portfolio, 5% growth, 25% fixed, that type of thing. Sheltering income, as long as that income is being sheltered, it's growing tax deferred, and in some cases it can be totally tax free. Keeping that in mind, that's the Roth approach. Small amounts can add up to huge drains on portfolios over time, and that's the example given by that taxable bond where you just had the interest each year being taxed. It's the same with stocks. If you have very high turnover stocks and they're constantly being taxed on those gains, or the client is, then it can have a similar effect. And then finally, it states here, plan withdrawals early. Location decisions today create flexibility tomorrow. What we're saying is, to the degree that we're able to plan ahead for asset location, we're not kind of stuck or in a corner down the road when we have a lot of assets sitting in one account and we're trying to move that money into a different account, wishing it had been in that other account. So knowing up front where you want those asset classes to be is a lot easier to get those asset classes into those accounts, whether they're taxable, tax-free, or tax-deferred, than it is to have these assets built up in those accounts, or maybe just one account, like a 401k account. Imagine this. A lot of people who have salaries, they do not have funds or savings outside of their 401k plan. So you have a huge tax deferred account. And what is it that we looked at that they have to be concerned about down the road? Remember, as they approach retirement or move into retirement, those required minimum distributions. And imagine having a $3 or $4 or $5 million portfolio and having this money forced out each year, even though you don't even need the money. And it's being forced out at very high tax rates. And so if there had been earlier planning, then the individual it's possible they would have been able to spread that across Roth accounts as well as taxable accounts and have more of a tax, we call it tax smoothing across those three accounts, bringing that overall effective tax rate down over those years and not having these spikes because all of that money or all those asset classes are sitting in one account. But what we're going to do is look at two cases. One is where we do have a heavy 401k plan or IRA where we have about $3 million embedded in that account with very little in the other two accounts. We just needed to have at least $1,000 or so to be sure that we could have accounts active in the software so we could move some money around. We're going to look at how that is done through maybe some Roth conversions. And then we're going to have an account where we have $1 million to each of those types of accounts. And we're then going to do some tax planning using perhaps some Roth conversions because there's something else that comes into play here that we're going to be getting into. It's called legacy planning, estate planning. And this is where high wealth families not only look at their own tax issues and try to figure out how to be as tax efficient as possible and have the least amount of taxes down the road, but there are also assets that can be left to their heirs. And so especially when you're dealing with large estates or even mid-sized estates, when those assets move to the children or to wherever they want those assets to go, if it's to an individual, then there's going to be a tax impact on that individual. They have to recognize that income. And remember when we talked about RMDs, we talked about how those accounts have to be depleted over a 10-year period. Remember the inherited IRA, the inherited 401k account. It depends on whether you're a spouse or a non-spouse. And so there could be a very tight time frame. And so you could imagine some extremely high tax rates that could apply if you have a $3 or $4 or $5 million IRA or 401k plan and the individual has 10 years to pull that money out. They're having to pull out a significant amount each year. And so planning ahead to prevent that, of course, is paramount. Okay, we'll stop there and move into the next discussion.